So welcome back to the Hyperspace Challenge webinar series. We're glad to see you all joining the call. As others start to join and trickle in, please take the opportunity to introduce yourselves in the chat and let us know where you're from. We really love to see where everybody's calling from. Here at Hyperspace Challenge, we're reporting from beautiful Albuquerque, New Mexico. So would love to see where you're all from, and it's just a great way to connect too. Some people even put their LinkedIn in the chat, so feel free to connect. And so I'm Dorothy Duran. I'm the Senior Program Manager with the Hyperspace Challenge. Again, thank you all for being here for today's webinar. This is part of an ongoing series hosted by Hyperspace Challenge, the Air Force Research Laboratory, and U.S. Space Force to strengthen the connective tissue between diverse communities within the space industry. One of the goals of this webinar series is to address common roadblocks that are faced between industry and universities whose desire is to support the mission of the U.S. government. We're super excited for today's discussion. We have a great one and a great moderator and panelists with very good experience and expertise. So today we're going to talk about a topic that was recommended by our audience. We'll be talking about navigating boards, investors, and governance as you scale. And through this webinar, we hope to provide practical guidance around governance, funding, and organizational alignment in venture-backed companies, and to give founders clearer frameworks for navigating growth while maintaining strategic direction and company vision. Before we get into the discussion, though, I just want to give a quick reminder and just kind of some housekeeping of how this will go. So after the introductions and once we get into the panel, if you do have questions that come up, please utilize the Q&A function. You'll see it down below. There's like a Q&A bubble. So please use that function rather than the chat for your questions, just so that we can keep the questions all in one spot. It's just easier for us to see and for our moderator to see, and so we can get those questions answered for you. So with that, I'm going to hand it over to Xavier Lemon, who is the Director of Entrepreneurship at C&M Ingenuity, and also our new Interim Program Director for the Hyperspace Challenge. He'll be moderating today and helping lead this discussion. So over to you, Xavier.
Thank you, Dorothy, and hello to everyone. Glad to have you. As Dorothy mentioned, my name is Xavier. I lead a portfolio of entrepreneurship programs at C&M Ingenuity. I originally come from Canton, Ohio. Some of you all might recognize it from the Pro Football Hall of Fame. But I spent a majority of my career between Boston, Boulder, and Oakland. But I'm now based in Albuquerque, where I am, again, leading that portfolio of entrepreneurship programs like the Hyperspace Challenge. I'm an angel investor and really enjoy helping folks that are either building, have an idea, developing a company and helping folks scale. So I'm really grateful to be your moderator here today. And I would like to take a moment to introduce our panelists. Let's start with Joe Daniels.
Sure. Hi, I'm Joe Daniels. I'm a partner and the co-chair of the Emerging Companies and Venture Practice at Nelson Mullins. I'd just like to say a few words about that firm. We're 1,100 lawyers, licensed over 47 states, all across the U.S., about 125 years old, and we have startup to Fortune 50 clients. We basically have a department for everything a business needs: corporate, intellectual property, litigation, real estate, tax, so many departments I can't even keep track. And then including regulatory things like for regulated industries, including space, of course. And then I'm the co-chair of this 85 lawyer strong emerging companies and venture group. And what we do is we help companies form correctly to be able to raise angel and then venture financing, and then later on strategic and private equity, and then actually, of course, drafting, negotiating, and closing those financings, equity and debt. And then, the growth stage, we help companies expand through acquisitions and partnerships and commercial agreements of every type. And then we help these companies exit through merger acquisition or IPO or any other type of maybe a D-SPAC, for example. And we're usually ranked in the top 10 firms in the pitch book, which is the ranking of deals by venture funds and law firms and others. For example, we were top 10 firms by for U.S. company side deals in the third quarter of 25. And we also are backed up by a bunch, I said 1,100 total, but, for example, 60 technology and life sciences trained patent, trademark, and copyright, prosecution, litigation, and licensing people, 550 litigators ready to sue and defend all over the U.S. And I've been doing this for almost 30 years now. I basically joined the group in Palo Alto that took Netscape public and sold it to America Online. So I know the tech startup business, and have represented a bunch of famous public companies that are household names like HP, Autodesk, Career Builder, used to be called Monster, a bunch of private equity and venture funds, and I've done 25 IPOs and follow-ons and scores of M&A deals and thousands of financings. Now I'm totally focused on space, defense, and deep tech because that's the only thing anybody should be investing in now, apparently. Of course, AI too. And I recently helped Grant, also on the panel, his company Paragon Space Development Corporation, to acquire Final Frontier Design, leading to Paragon being a core partner of Axiom Space and building the Artemis spacesuits, along with some potential, strategic transactions with household name companies, space companies, and I also represent other. And my team, for example, recently represented Hermeus in a $350 million C round, and this is these guys focus on the rapid design, building, and testing of high Mach and hypersonic aircraft for the national interest. So that's why I'm talking. I'm on the panel here today. Thank you.
Wealth of experience, but you're right. Space is what folks should be invested in. Thanks, Joe. And how about Grant Anderson?
Sure. My name is Grant Anderson. I'm a co-founder of Paragon Space Development Corporation, founded 33 years ago in 1993. And I'm was the president and CEO for the last 11 years that I was at the company. I actually retired in December. However, I'm still on the board. I'm the treasurer of the company. I have to kind of go all the way back to my childhood a little bit. Don't worry, it won't be long. I was the son of a diplomat, so I grew up moving around. My last 3 years of country, now we're not only in three different high schools, but three different countries in high schools. And the reason I say that is it gives me a slightly different perspective, especially on relations within a company and how to get accepted and work with people to integrate very quickly, which almost every single high school class has to do, as you have a third of your people new every single year. What I generally specialize in, though, I've been mentoring CEOs, mainly female CEOs. Paragon was a women-owned company. I started it with 3 women and another guy. And what I try to do is impress upon people that every business in the world is a process that creates more value than it costs. That's every business in the world, and very often, the value is the price. The cost is great old general accounting principles, GAAP. But a lot of people forget about the processes. And so I'm a process-oriented person. My training is in engineering, not in business. All of my business experience is hard knocks experience. I have 2 books that I keep. One is All My Successes, which is about this thick, and All My Failures, which is about this thick. And I refer to this one a lot more than this one. Let's put it that way. What I have been known for and got a reputation for is developing technology, taking it from a concept to actually something that could be a customer product in a very hard field, which is life support. Paragon does life support in extreme environments. Space being the ultimate extreme environment, that's 80% of our business, or was, or is at any one time. Some government, some commercial. Yes, I helped Elon start SpaceX, among other things, over my long career. But in reality, what I did is start a niche company that has an infinite market because no humans will get off the planet without a life support system. So I used to have a poster outside my door, which was the artist rendering of the Milky Way galaxy, and I just sat under it, Paragon's business territory. That's where it is. So that's where I'm coming from, and I'll hand it back to you, Xavier.
Infinite market. I love that, Grant, and I'm really excited that we're going to get a founder's perspective here in this discussion as well. Thank you. And how about AJ Smith? Let's hear your background.
Absolutely. Hey guys, really grateful to be here. I've been a lifelong builder and creator, and now I get to be a force multiplier on the other side of the table at Outlander VC, where I'm an investing partner. Um, for myself, just quick background. I mean, from TI-83 games that I'd sell to my classmates to writing music and all that kind of stuff, and then building infrared sensors for the US Navy when I was 16, eventually writing songs and touring all over the world. I've just been obsessed with creating and putting things out into the universe. Luckily, I ended up having a pretty cool career through all of that, that ultimately led to me both being a venture-backed founder and CTO, and then eventually investing in startups myself. So I started a fund of my own about 7 years ago called Level Up Ventures with a buddy of mine. We ended up our anchor LP there was wanting to invest more in CPG. And while that's a really fun area, it's not an area that I was thinking when I was kind of like Joe was saying, when I'm looking at where are the areas of critical need for technology and for the future of humanity, really, I started thinking, predicting fizzy drinks, not for me. And so I ended up looking around the universe to say, who's been the best at identifying founders pre-product, pre-traction, pre-revenue. And when I looked around, it's a really, really small universe of people who are that good that early. And Page Craig GP at Outlander, we cut half a mil to $3 million checks at pre-seed seed, often pre-product, pre-revenue into the founders. Just exceptional people. We've had 18 unicorns so far. We'll probably mint another couple this year and next year. Just in recent memory, we've been known for being first check in Scale AI, but also super early in SpaceX as well, and a bunch of others. Lyft, Wish, Gusto. You can go check out the logos on the webpage. And then within the defense specific sector within Fund 3, I mean, we've been investing in defense for a while, but you might recognize names like Havoc and Aurelius or Noda, Glide, and others. I also led our most recent space investment into Catalyx, which is they're doing, you might have seen them mentioned in some of the reentry articles that were coming out over the last week. Just they're doing high tonnage reentry. Core IP being a flexible thermal protection shield, and they're awesome. And I think before this, Grant was talking about the India market as well, with just such a wealth of talent and amazing founding team. They've got split presence between India and the US, which is an important ally when we're thinking about the next this next era of space. Anyways, that's me. That's Outlander. I won't wax poetic anymore.
Awesome, AJ. I love that you're bringing a wealth of investing experience and some really well-known logos there, as well as quite a bit of overlapping experience. So I'm really excited. We've got three rock stars here on this panel. So without further ado, I'd say let's go ahead and jump in. Just quick format. I've got a list of questions here to ask you all. Some of them I'll be directed towards someone. So I'll ask someone to lead, whether just something you talked about or maybe a bit more pointed, relevant experience there. But then I am going to ask that everyone has a chance to answer those questions and give their take. We might even have some back and forth between one another. That's also encouraged. And then the folks in the audience here, please use the chat to drop some questions in for us as you're hearing things that are interesting. I will make a point to visit those as well. But getting into our first question here, I'm going to start with Grant and your kind of experience as a founder and co-founder. We often talk about founder control, but it changes drastically as a company scales. Beyond simple equity ownership percentages, what does true strategic control actually look like in practice once you bring on institutional investors and formal boards?
Okay. Well, I would say it's what I said at the beginning of the process. In reality, the control of a company is the person who understands the process the best, especially how the process is unique from a vanilla company. I mean, very often I would hire somebody that had been to a Raytheon or a Boeing or whatever. They come in and try to impose processes upon a company that had gone beyond those processes and made them better. So, founder control, in my case, I've never owned more than 20% of the company. So I was not I was not it wasn't like I had the last say at the board meetings and everything else like that. So what I learned is that the real control comes in the person who understands what you're really trying to do, and making sure that the vision and the mission, which so much nowadays are platitudes, that they actually have some meat to them, and that you have the processes that is trying to produce that vision and get to that vision and produce it through the mission, making sure you understand them better than anybody else. And then when you're fighting for control, and I've had to do that too, when you bring in other people, making sure that when they start trying to change a process, that you can not block it per se, because you can always improve a process, but make sure they understand what they're trying to change. One of the things has been, even before I started that company, I'd started a few more before I started Paragon. I had people come in and say, I hate this process. And then you'd say, okay, go up on the whiteboard and write a flow diagram of the process. And none of them could do it. They essentially hated something they had no idea what it was. And so I found that one of the best ways to maintain control is to be the person who could just get up on any random meeting and say, here's what's supposed to happen, what's broken. And that type of maintaining control, it sounds a little bit like you might get into the founder's problem of the company outgrows you. But the company does outgrow you in some ways. There are certain processes that are very generic to custom companies. Let somebody else do that. It's those core processes that really make you different, that you have to maintain the best understanding of, be the best advocate for, and really keep it simple, stupid, so to speak.
Yeah, really, really interesting point. A lot of times we think about, really deep vertical understanding in some of these things, but you're saying you've got to be the horizontal expert there as well. Really interesting point. AJ, Joe, anything that you guys would add to that? Any follow-ons or thoughts?
Yeah, I mean, I think a big misconception among maybe the earlier founders is that like Grant mentioned, is 20% uh, ownership. I mean, the bottom line is that if you've been made the CEO, or you're in line for CEO, and or you're a founder CEO from the get-go, and everybody loves you and you're totally indispensable to the company, they're not going to get rid of you. And not, I guess I should have added, and you're performing at the level that investors are happy with, right? Um, and bottom line is, ownership is not what controls the startup. Control, especially when a company becomes venture backed after your first price equity round, is actually controlled by agreements between the company and investors. And you could also refer to the certificate of incorporation and bylaws that specify who controls the board, what size is it, how many seats founders get, how many seats investors get, how many independent directors do you have to break ties and things, and then what rights do investors have to block various company actions. And I know these documents backwards and forwards. So I've done thousands of these deals, five complete different set, documents. I'm not going to tell you the names because it's boring, but and what this shows you is that the agreements are focused on uh, 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 setting forth, who controls the board, and how, extreme is that control, and what do you have to get the investors' approval for? And the reason why it's focused on the board is the board is the most highest governing body of a corporation, which is what startups should be for tax reasons. And the board has to approve all the major company actions, like hiring and firing the CEO, selling safes or stock to make money, selling the company, changing the size or structure of the board, and many other things. So it's important for founders to understand the system, or governance structure. And another misconception is that founders often control through or past the exit. And sure, there are exceptions like Elon, where you have this incredible ability to create fear of missing out. But the typical startup board is controlled, after the pre-seed and the seed rounds, by founders, after the A round by founders, and very commonly shared control, like two founder directors, two investor, and then one independent. Um, but it's sort of, I don't know, 50-50 for the A round. And then by the B round, it's usually almost always controlled by investors, or a very high percentage is controlled by investors, or at least shared control. And the way that works is you have to mutually agree upon an independent director. And you should think about the fact that you would probably prefer to identify that person first and then have the investors approve that person if you were thinking about retaining control. Because if the investors have pre-selected somebody, that generally will suggest that they are going to be looking out for the investors potentially more than you. So practically, founders should be thinking about fighting for control at the pre-seed and the seed and even the A rounds to extend control of the board, that is, but then focus on, and in fact, the whole time you should be focusing on people that you trust to put on the board who have a background that's operationally powerful, somebody that could help guide the strategic trajectory of the company, who are more likely to support you instead of the investors. Because if you have these three common directors that you appoint, you want those people to be voting with you. And a lot of people have a hard time, finding those people at the right moment when you first do a priced equity round. And then you want to build a really good relationship with all the investor directors so that they see you as, I think what Grant was trying to describe, is the only person that understood it. I call that indispensable to company success. That's a word that is thrown around the Silicon Valley constantly, that the people that are well compensated are indispensable. The people who are still here on the team are indispensable. That's why they're still on the team. Also cooperative and not difficult, trustworthy, so that you have a durable influence after the B round. And then if you're successful and you generate fear of missing out like Elon, you can just talk to me, because I have every option in the toolkit that you've ever heard of to keep control absolutely as long as possible. For instance, going into 1A round, I had a founder that, the big investor, lead investor was SoftBank. They had a bunch of other funds in there, $100 million A round. And he wanted 9 votes for every investor vote. So it's just, I mean, if he simply had 2 to 1, he would always win, right? But he didn't want to play any games.
So I'm hearing you say that, really founder control it should be part of your strategy, and it's something that should start early, whether that's going to be in deciding, who's your board going to be and folks that will support you. What are the governing agreements that would really help drive this? So
Yeah.
I think that's really good points to think about, Joe, and an interesting angle, especially coming from a legal perspective. But I'm curious, AJ, now coming from the venture perspective, what are your thoughts on founder control as a company scales?
Yeah, 100%. I mean, I think, at the end of the day, I want to double click on something that Joe said, which is that if you're doing your job as a CEO really well, why would the board ever want to remove you? And I think that's the biggest thing that founders are often worried about, especially early on, is they have this fear of, oh, if I go and I start taking in investor dollars and then they take a board seat, I'm eventually going to get fired from my own company. And look, that can happen, and it does happen. And there's certain funds, you can look them up, that are a little bit more notorious for that than others. But at the end of the day, remember why we are here and why we are usually backing founders. And that is because we believe that there is a massive amount of upside in supporting your vision financially, and then also with, how we then work with you. Early stage. Remember I think this might be a question that we're going to get into, but remember that this is a two-way relationship, and you should absolutely date just like they're trying to date you and figure out whether or not they want to go and spend the next decade building this business alongside you. You're going to be one of many at their portfolio, and they'll eventually be one of many of your investors. But if this is a board member, this is especially early stage, make sure this is somebody that you actually could see yourself rolling your sleeves up alongside for the next decade, right? And at the end of the day, let's talk about why. Maybe I'll share the investor perspective. Why do we care about a board seat, for example? Obviously, yes, there's the general rights and things like that matter. Co-founder breakups do happen, and having sometimes a third person to help navigate that can be useful. Also, just having a good attorney can also be helpful in navigating all of that. Um, Influence at the right mattering moments can be super important. There's oftentimes, and this is speaking as a founder friendly VC, if I'm taking a board seat early, it's for me to teach you how to run a board and teach you good governance practices. It's not to hold onto a board seat forever. It's in order to get you used to running quarterly board meetings. And so then by the time that you get to that Series A, by the time you get to that Series B, you're trained and you're ready to own that board meeting and go into those and have everybody be excited, or at least turn those board meetings into what they really should be, which is, hey, I've got a bunch of smart people here. These are some of the problems that I'm dealing with. Let's solve them together, right? And so, like influence in those moments, though, can be, and we've had to do this multiple times. Everybody else on the board is starting to get scared. Everybody else is starting to say, we think this is going to go to zero. We should not bridge this company. We should not put any more money in. Maybe we need to replace the CEO. And because we come in so early and because we invest in people, oftentimes we can be even just in an observer capacity, even not even as, a voting board member, we can still be a voice in that room that can say, no, guys, we have known this founder and been working with this founder for a very long time. They've gone through X, Y, Z. They've triumphed every single time. This is just a momentary setback. We need to bridge them $20 million, whatever it is. And then, why else do we care? I mean, there's a whole bunch of, reasons that I guess we could get into, but the biggest the biggest thing is helping to steer, especially younger founders, I'd say, in this era, that don't have experience can be important. Making sure that you aren't going to go and take on a bunch of debt uh, in a really dumb way, or do something where you're not thinking 18 months ahead of what is this decision going to do and how is it going to compound and potentially kill my company. Um, that's just another example.
Yeah, that's really good. Get over the fear of the investors replacing you because they chose you, right? And hopefully during that process of the date before you marry, you've realized that this is someone that, sees the strengths and weaknesses and is able to teach, like you said, how to govern if it's an early board. I really like that. And the choice and investment in the founder is clear there. So AJ, actually back to you. Or excuse me, yeah, AJ, back to you. So early stage boards look pretty different from growth stage boards. How should founders think about the evaluation of their board composition? Specifically, how do you transition a board from an operational working group into a mature governance body without creating some immediate friction or just a boom, quick turn of the page?
Yeah, I think, a good way to have founder control, let's use, control here, and tie it to the previous question, is to actually just own that leadership right from the very beginning. And so some of that can be, asking smart questions and go, hey, I want to actually get on a quarterly board cadence with you. I want to be in our monthly portfolio support calls, all of that, but you own how you are going after your board for support. This is once you have somebody on. And in doing so, like, you prep that quarterly board deck, you go through, you ask for feedback, you say, how can I improve? How can I make this better? And oftentimes, I think on our side, especially pre-seed, seed, Series A, we're very impressed with founders who are constantly learning, constantly growing, constantly evolving, and are prepared, right? Prepare. And when you're treating it like, hey, at the end of the day, I have my North Star metrics that I'm, tracking, my main driving KPIs that tell me the health and success of this business. Part of why it's important to even do these core, even if it's just you and your co-founder right now, it's probably good to get yourself on these quarterly cadences of board meetings and put together a presentation, because that way you can hold yourself accountable towards the goals that you set and how are you actually targeting towards those. And then, how does it transition? I think if you're doing that early on, then it starts to transition from just a working body of portfolio support and all of that into a more formal board meeting that now you've practiced for, you've prepped for, you've run that meeting multiple times. It's just like anything, getting reps can be helpful. Um, there's another part of your question that I think I might have dropped.
How do you minimize the friction in doing so? But I think you might have kind of answered that from and owning it from the beginning, right? If there's muscle memory there, it's not a new change for these folks when you say, well, here's how these things are running because you've made those calls from the beginning, if I understood you correctly.
Yeah, the dating part. And so I think part of that is, how are you assessing a board member? And it comes down to, what are your gaps? Where do you actually need support? Do they have experience in this sector? Is this somebody that's going to be able to help you level up in X, Y, and Z? Talk with their previous portfolio companies or companies that they've been board members on as well. Remember that this is a two-way diligence process, right? So, I am completely comfortable with you talking with any of my portfolio companies, and anybody that doesn't want you to talk with their portfolio companies, probably has some skeletons in the closet in terms of how they've handled things before themselves, right? Um, Now, look, there's some spiky VCs just like there's spiky founders, and like they will probably say, "Look, I made a hard decision and I defend that decision, and the founder was not performing where they should have." But they'll be open and honest with you if that's really what they believe. So, do your diligence and ask questions, ask to meet their portfolio companies. We likely aren't going to, like, I'm not going to introduce you to Zach from Coco, Alex from Scale, or anything like that where right now, like, these are busy guys. But there's others that I've been more in the trenches with recently that we're happy to facilitate those intros.
Awesome, awesome. Grant, what's your take on early stage boards at different stages? How do you think about board composition and how do you transition from, your earlier maybe pre-seed working group into a mature governance body without creating friction?
Yeah, I really liked AJ's answers there. I mean, one thing I do want to say up front is I have seen so many times that people try to get people on their board that can sell, and I think that's a mistake. That's an executive function, the marketing and all that type of stuff. Yeah, they can make introductions, but I've never seen a successful board member that comes in and brings in a huge base of business somehow. So I don't think that should be our criteria. What AJ said, though, about maturity, understanding the governance model, how governance works, that it is, really a hiring and advising on executives and advising on the strategic plan and giving some approval and portfolio to how you're going to allocate the resources of the company to go after what you're going after. But what I've seen a little bit with bringing in experienced people in the industry is if you've got a real innovation, they will stifle the innovation because it doesn't match their experience. So you've got to balance that a little bit. I won't name names, but I've seen board members that bring in especially ex-government officials that ran something, because of course space in the past was almost all government things, and boy, that slowed down a lot of innovation in a company. The you can't do this because we've never done it this way problem. So you have to watch out for that in a business. I think as you grow, again, making sure that you are doing the smart stuff. Like I said, when in part of my introduction, there are processes that are just standard across the company, across almost any business, or at least in the industry you're in. Knowing that, making sure that you're not spinning your wheels, reinventing those things, so you're actually putting your resources where you should go. You need the board to understand that and not push you towards the latest and greatest software solution maybe that is unproven and stuff like that. I would also say that the one other thing I've seen is having that trust and rapport with your board members, so nobody's never lying to anybody else. One of the weird things that I do is I hate PowerPoint. I believe the power corrupts and PowerPoint corrupts absolutely. But AJ mentioned decks. In reality, and I'm in a board meeting tomorrow, and they're gonna have a PowerPoint, and I'm gonna say, bring up the ERP system and show me what the data is today. What you're showing me is data, a month ago, and the world's changing fast. And if they can't do that, they're not using the tools. So that they use. And I get pushback all the time on that. PowerPoint is more like a canon of religion than it is an actual tool, is the way it's been used. That's getting a little far field. But then all in all, it's that maturity of understanding the board's role and not overstepping that, not getting down into the weeds, not having board members talking directly to your mid-management or to your VPs. Again, if you're a good leader, you have no problem with that because you're all aligned. But I have found that as you grow, you get more and more people who want to play politics as opposed to keep the goals of the company in mind. And then you start getting into problems because then boards start developing favorites underneath you, and that can cause a lot of problems. It's probably more
Sure.
than enough said, and I've thrown enough hand grenades for a small war. But yeah. Mm.
Very good, Grant. What I put in bold actually here, selling is an executive function, not a board function. Just wanted to repeat that one because I think that is a common misconception there. Now over to you, Joe. I'm curious now, we've talked about the board functions. I want to now pivot to how we think about, managing in our relationship with our investors. And I'm curious, Joe, if you have any advice for folks and, what we mean by date your investors before you marry them, or if you have any non-negotiable conversations that founders need to have upfront to prevent friction down the road.
Right. I mean, it's probably something you want to talk about like after you've set a valuation or a cap with respect to their investment. But one big thing is what are they seeking to achieve by investing in your company? Um, Investors have a different. I mean, the number one thing I think is that investors have a different timeline because funds usually have an 8 to 10 year life, and usually you're only investing in the first 5 years. So if you're at the tail end of that, in the fifth year, they make one final investment out of the fund, and that means they would like you to get liquid. In other words, for the company to get sold in 5 6 years, and it may just not be at the point where you want to sell it. You think you can raise 50 million bucks and make it into a much bigger company, unicorn plus. And they just want that exit so they can get more, return results for the fund, which allows them to then raise the next fund or helps them raise the next fund. That's a clear tension. And different investors, like the pre-seed investors, are getting in at 5 million cap, and the A people are getting in at 50 million. They have different entry prices, and then they have different return targets depending upon the type of investor. So there's all these potential conflicts, and the more you start looking at that, talking about about potential with potential investors after you get offers, about what they're looking for, can help you predict whether or not you're going to be aligned down the road. And that can also help inform you as to what terms to agree to and not agree to. Um, for example, there's a term out there in deals called, well, there's a sale right. VCs can sometimes make you sell the company, and sometimes they want to select the investment banker and deal counsel and all these things. And there's drag along, right? I mean, I can go on and on about the different things that when we're on the investor side, we help investors guarantee liquidity when, as a founder, you may not want that. And then it's everything that AJ and Grant have already said. You want people that can give you, help with strategic trajectory, vision, this kind of thing, governance, not management. Um, and they're not, but what I mean by governance is they're and not management is they're not just advisors that give you tips and things like that. That's a separate kind of person. You give people little equity grants or up to 1% of the company to be an advisor. That's like a paid position. It's like a contractor is getting equity and earning it over time in exchange for advice. This person has a significant fiduciary duty to look out for all shareholders' interests if they get on the board, and they're there to monitor the performance and your performance and risk and capital allocation, like Grant said, and holding you, CEO, founder CEO, accountable if you are one, I'm assuming. Deciding major strategic things like the blocking rights I talked about, namely raising money, selling the company, hiring and firing the CEO, and sometimes the other C-suite people, and whether or not you make any equity grant, the board has to approve that, and that's a majority of a quorum. So if you have three directors, then you need two people to pass anything, and you have to think about how all these different how that person fits in the equation and could potentially slow you down when you want to do something, or make you do something if they
Mm.
have control. And management is you're the guys, the CEO and everybody down. in the chain is there to execute, not the board. You're supposed to be doing the operational stuff. And sometimes when negotiating equity financings, they ask for a lot of operational control. Like AJ mentioned, you don't want some founder to go and borrow a gigantic amount of money for on the wrong terms, or however it doesn't make sense. In many ways, it doesn't make sense. So they often ask for a right, as the preferred director or one of them, to approve a loan over $1 million or whatever the number is that makes sense.
Sure, sure. Thank you for that, Joe. Grant and AJ, I know we touched on this, in some of the previous questions, but do you have anything that you'd add in terms of non-negotiable conversations that founders need to have up front, when you think about dating before we marry?
Please go
Grant,
ahead.
I'll defer to you for okay, sure. So I love how polite we were just word that.
Yeah.
So yeah, I think some of the FAQs there's different stages where you might ask some of this, right? I think Joe made the great point of sometimes there's certain things you want to wait until you get to, okay, we've committed, we're going to do this at this valuation and do this check size before you start going into more. Um, but up front, I mean, you can definitely ask, like, hey, how much in reserves do you have? How big is your fund? Where are you in your fund deployment cycle? I'm just trying to, do you lead? Do you co-lead? Do you follow? A lot of these FAQs. There are later on, you can also ask too, probably not in a first conversation, but oh yeah, and by the way, as I'm just starting to think about all my VC conversations that I've been having and assessing, like who am I going to be building this company with alongside? That language is particularly helpful, by the way, something like that. It's just generally collaborative. Then and you can say, I'm just trying to understand, like, generally, what does your LP base look like? Try to figure out if they're institutionally backed. Are they going to be around for a while? Now, that said, emerging managers can often be the ones that are actually going to roll their sleeves up the hardest for you. They are not resting on any laurels. And so remember that it is sometimes the partner or the person over even the fund name or even over like how big of a fund it is, right? Like you definitely want to go and pick sometimes your 250K check writer as opposed to your 1.5 mil check writer might be the person that works hardest for you from your pre-seed, just because they're the ones who this is their first fund. If they don't make this a success, they are not going to be able to raise fund two. And if they don't make you look like a rock star, they are screwed and they're looking for another job. So,
Yeah.
remember to date the person and make some of these choices based off of the people. Now, you're probably not letting that 250K check writer on your board. Um, Back to the general board conversation, but these just are all FAQs that are important to ask. And then you can also, as you get further on, if they're starting to bring up a board seat, you can, or even earlier on, you can ask, do you typically take board seats? Do you do observer? Do you info? What are your typical things that you ask for? Um, and then later on, you can, if they do take a board seat, you can say, how do you typically like to work with your companies at this stage as a board member? And where do you feel like you provide the most value based now that you've gotten to know me, where do you think that you will be the most valuable person on my board with me, right? And allow people to defend themselves a little bit and pitch themselves because if you're building something freaking awesome that somebody should want to be a part of, then make it that two-way relationship.
Excellent, excellent. I love that. And really the emphasis, again, on the person there, right? Where are they in their process? Is this an emerging fund? I think those are really great points and great FAQs you shared, AJ. So I've got one last question for us, guys. We have been crushing this. Can't believe we went through our time already here. But the one question that I have, and I'll, ask each of you individually, but starting with you, Grant, if you could put a warning sign in front of a founder regarding governance or legal structures, what would it say? What's one mistake that you see founders make early that becomes incredibly difficult or painful to untangle later?
I'm sorry, AJ, I have to say this for you. Don't trust VCs. No. And to some degree to tie in that what AJ was talking about before, what I've found is using a lawyer like Joe, and you come to an agreement, you think you have an alignment and stuff, write it down. And if it gets to the point of the VC looks at it and won't sign anything, you know that they're not really being as truthful for you. If you really came to a meeting of minds. Um, but and maybe that's it. I can't attribute it, but somebody said the problem with communication is the illusion that it actually happened. And so that's one thing I think is with a founder and building up a board and stuff, getting things written down. What are the rules of the road? How are you going to work together? All that type of stuff. Again, there's lots of templates out there. There's a lot of differences. I will say my joke about VCs is I started an airline. I helped start an airline in 1984 and 85 when I was still in college, and it went 6 months right on business plan. Then the VC said, "Well, we're no really longer interested in this," and literally had to shut down the airline in 3 days because you don't run an airline that doesn't have money. So I got gun shy real quick. And making sure that you're aligned. Of course, the alignment and everything was well above my pay grade. I was just on the team that was doing this airline. So making sure those alignments are there, and that as you grow, as you get more board members and more, and I'm kind of biased. I think a board of more than 7 people is probably too many. But yeah, maybe if you're a billion trillion dollar company like Apple, maybe. But so getting those things down, making sure what the rules of the roads are, and trust but verify. I'll go back to Reagan. Trust but verify, which is actually a Russian term, actually. But okay, that's probably.
Awesome. Thank you, Grant. Uh, if you didn't get the signature, it might be an illusion that it happened. I really like that takeaway there. How about you, Joe? What's the warning sign you'd put in front of founders, and or what is an incredibly costly mistake that's really difficult to untangle later that you've seen?
Probably negotiating a lot of the term sheet without counsel, right? Because term sheets are in a special language that VCs and expert lawyers and expert founders only understand. And changing a word or two can dramatically impact the amount of dilution you get in that round, what the governance is going to look like going forward. And so you need to get, if you're doing a price equity round, you need to get somebody like me involved. And it's not like I have to spend 15 hours looking at it. I've looked at 5 already this week, so we're pretty fast at that. And the other thing, it's a real, and that's when you do your first price equity round. Usually pre-seed and seed deals are all safes. Sometimes the seed is a light preferred, and you typically don't have any like governance issues or other any issues other than the cap of the instrument. Which if anybody doesn't know what I'm talking about, just email me. Except sometimes people will ask for side letters. They ask for most favored nation. They ask for pro rata. Yeah. Well, let me just explain. So most favored nation, we usually just flat out reject because it's fundamentally unfair for somebody who invested $5 at a, let's say, $20 million cap, to get the same deal as somebody who puts in $3 million at a $10 million cap, right? And that's what most favored nation would get, the earlier investor there. And pro rata rights and information rights, we usually just say try to restrict that to a very small number of people, because generally when people get a pro rata right or a right to buy the same percentage of the next financing that they're investing in this financing, or as they would convert into the cap table, assuming the next financing, then that dilutes the founder, right? Because you've already negotiated the valuation with the VC, and those guys, and usually it's post money these days. So if investors are doing it the typical way or the smarter way, and then the founder takes all the dilution on the additional amount invested in information rights. You don't want everybody and their mother to have this, information about your company floating around out there.
Sure. Yeah. Really, really good points. I like that. It's a special language in those term sheets. Will versus shall being an example of that we learned in a past life.
Oh
How
yeah.
about you, AJ? You want to bring us home? Any warning sign that you put in front of founders, or one mistake that you've seen founders see that's incredibly difficult or painful to untangle later?
Yeah, quick double click on something that Joe said, which is, make sure that you're not just giving all these tons of rights away to tons of people super early on, right? Like some of the things that he mentioned, that's usually reserved for like your one big, big, big check writer at your seat or something like that, right? And even some of those, like Joe will negotiate those for you in order to make sure that you get what's best. But I think this then angles into what I think is one of the biggest flags that can straight up kill a deal, even at pre-seed or seed, is if you become too hairy too early. That could look like going through like a weird venture studio as opposed to some sort of like a well-respected venture studio, where maybe you're a spin out from another company and now that company already owns 50% of you for actually really only putting in like 100K or something like that, and giving you the office space to work out of. And then at that point, I'm thinking, okay, the CEO and co-founder and the people that are actually building this, they already don't own hardly anything. Incentives are not aligned from day one, and this just looks too hairy for me. Or giving extremely favorable terms to like that 25K angel. Like if you're giving them a really egregious side letter super early on. Um, to me, all of these are basically symptoms of you've become now what we call this is a really hairy deal. And so if you become too hairy too early on, it can actually, rather than get investors excited, like, oh, here's somebody who, you know, I can take advantage of, like the don't trust VCs, like, hey, trust but verify 100%. There are a lot of sharks out there. But like to those of us who are actually honest, good businessmen who have especially been on the founder side of things too, um, who just want to go and change the world together, if I see something like that, I go, bad judgment. I don't know if I want to be investing in a founder that gave this much up too early.
Sage advice. Thank you all, gentlemen. I really appreciate this. I learned a lot here on this panel. I'm sure that our guests here did as well. What I'll do, we've just got a couple minutes here. I'm gonna pause it, open it up, see if we had any questions from the folks that are viewing online.
We have 4 questions in the Q&A. I can just start reading them off if you'd like. So we have a question for AJ. When you look at a founder building ahead of the market, what tells you they have the clarity, discipline, and timing to become the kind of company investors want to back?
Yeah, super short answer. We've got a great blog post on our website that I think was shared in the chat, but it's on our founder framework. And so when I'm assessing deals super early, I'm looking at vision, intelligence, character, and execution. And so when you're saying that you're building ahead of a market, that to me, I'm thinking, okay, where within your vision, it does this seem like there is some eventual value here? Is this a market that is 10 years away? Back to Joe's earlier point about remember our investment fund cycles. And there are funds that invest in like truly, truly frontier stuff. I'm investing in deep tech, but it does need to have some sort of imminent value within the next decade, right? Um, that said, I routinely invest in founders that are maybe building ahead of where consensus is looking, because that's ultimately how you take those risks, you can drive big returns. And so then what that means is that I'm often assessing all of these other categories. I'm looking at, okay, well, I, when I say intelligence, by the way, I'm not just like meaning, oh, like go take an IQ test and send me your results. No, what I mean is like, what are your insights that you've taken away from your experience in life? And even if you're really young, then I'm thinking, okay, what are the unique challenges that you've put yourself through? Whether it's, like math competitions or chess club or robotics and all of that kind of stuff. And how have you risen, and even inspired people who maybe are smarter and older and more experienced than you to follow you? And then within execution, that's just the done. Are you the type of person who actually follows through in terms of what you say that you're going to do and get it done? And have you historically dragged your feet? Have you had failure to launch? Or do you actually move things forward with whatever resources that you have? Do you make excuses because you haven't raised a bunch of money to at least get started on something core to what's going to drive the success of your business? Or do you push forward one step at a time? Do you wait for no one in order to actually go and make this inevitable? And then the last thing that I'm assessing, which most VCs honestly don't even think about, this just comes from the gut, but we've actually really put a lot of thought towards it, is understanding your character. And I think that oftentimes founders need to even assess this for themselves. Like, do you have what it takes to actually go and build a venture-backed business? There's going to be a lot of ups and downs, and it's a hard freaking road. And so you can build character, You can build resilience, but you need to be resilient for this journey. I'm sure Grant could tell you about all the times that you absolutely need to test yourself, right? And you can be up against 1 week of runway and you're thinking, do I have to lay people off? And then somehow you pull it out of nothing in order to make it happen. And if you can't perform well under those constraints, you probably shouldn't be a founder yet. You can train yourself, it's a muscle. You can train resilience, work on that. Discipline, execution, all of those things. And so that's how I end up assessing the person that early when there's no other signal is I look at all of these maybe what you would historically call intangibles and we try to make them tangible. Long answer, long, I guess. Sorry.
Awesome, thank you. I think we can squeeze in one more short question. This one is for Joe. It says, do you see more people using seriesseed.com docs?
We see less people using that. I mean, and it depends on which geographical region of the country. Sometimes they sort of take off in a certain area, but then as companies get like later stage, they eventually convert to what is they call the National Venture Capital Association forms because basically everybody uses them in order to standardize and reduce costs and or legal fees and expenses in producing deals or deal documents. And but uh, they're dying now. They're dying. They're pretty much dead. Yeah, they're pretty much dead.
Good to
Sorry,
know.
I think they've been replaced by safes. I think they're replaced by safes fundamentally. Everybody loves safes for numerous reasons, including QSBS when you buy them. Yeah.
But make sure you have a good attorney like Joe. By the way, I've used Joe too, so he's the common denominator here. Because if you stack a bunch of safes and you're not tracking how this is going to actually look, um, hygiene is important.
Yeah, a bunch of post money safes. I'll just tell one little war story. There was a A16 Z was checking out a cap table and asking the founder, our client, who was building a nuclear power plant, why is it that you have all the safe shares in the post money? Like you're issuing them as part of the round. Why is it not diluting you? Why do we take all the dilution or share the dilution on that? And we just like tweaked it and showed it what would happen if that were the case. And the founder had I think he had 70%. He went down to 0.0013% or whatever it was. So a lot of safes can seriously dilute you. Yeah. Pre-money, maybe not so bad.
Well, this was great, folks. Joe, AJ, Grant, I really appreciate you taking some time for us. To all the folks online, I really appreciate you spending the last hour with us. I hope this was fruitful. You do have contact info there in the chat if there was questions that you wanted to ask that you weren't able to. But otherwise, I'll hand it off to you, Dorothy.
Thank you, Xavier, and thank you so much to our panel. You guys are amazing. Really appreciate you taking the time and sharing your knowledge. So I'll be super quick just to wrap up. We put some links in the chat for you. We have July's webinar. We have the registration link in there. So we hope you join us next month. We have our mailing list that you can sign up for and our YouTube page if you want to see all of these wonderful webinars. We have a whole library of great content. There will be a survey that will pop up when you exit the meeting, so please just take a minute to fill that out. We really do use the feedback to improve our webinar, and we do listen to your topic suggestions for webinars. So with that, I'll let you all go. Thank you all so much for being here, and we hope you have a wonderful rest of your week. Bye, everyone.